All right, you guys. We're gonna talk a little bit about trading. Now, I don't know if you guys have noticed, but I try to keep the topics a little bit away from trading and investing, and for the most part, is because I continuously try to show people how many different ways there are to get active in this industry without necessarily just trading and investing. I mean, most of the people that I know that are overly successful in this field aren't traders or investors. They usually build in these projects. I mean, I guess we invest some as well, but for the most part, it's people that have actively built projects in this industry. Those are the ones who are generally the most successful. However, this brother right here, John Devine from Blockfills, is actually a very talented trader himself. He's from the CMOE. Those of you who don't know, it's the Chicago Mercantile and Commodities Exchange. And ultimately, he's got a lot of experience in trading, but I'll let him tell him a little about yourself, brother. Go ahead and introduce yourself to the people.
No, well, number one, thank you all for coming out tonight. I think we've all had a long week with the inaugural blockchain week here in Puerto Rico, which was a fantastic success. And Pedro, you had a lot to do with that. So thank you for what you did, and then also thank you for what you've done with Crypto Mondays. Exactly. So when I first came to the island in 2018, this was a pretty small community, and what Pedro has been able to do is is incredible to witness, and this community in particular really makes this island a special place. I think. We all love the beach and we all love to go salsa dance, but it's really the conversation we all have with each other and the vision that we share in this blockchain space that makes this island such a special thing. So thank you everybody for coming again, and thanks for having me speak.
Give me a round of applause. Give me some love, Dan. It's all love. So tell us, John. Tell them a little bit about yourself. How did you get to this point, and why is it exactly you sitting up here next to me today, sir?
Yeah. So when my first Crypto Mondays meeting, I thought to myself, how cool would it be if one day I could get up there and share some knowledge with the community that could bring some value, and here we are in 2021 and we're doing just that. So my background is commodities, futures and options market maker. So I did that at the Chicago Mercantile Exchange for a number of years, along with the Intercontinental Exchange. I made markets in precious metals, interest rate swaps, energy products, the whole thing. And in 2017, when the CME group listed a Bitcoin futures contract, I was there on day one with some bids and offers in the market, and I thought to myself, this is not going anywhere. If the CFTC is going to approve this thing, Bitcoin's here to stay. So I dove full in, head first. Ended up moving to the island in that following year, and my background in crypto started off at a hedge fund here. I was an execution trader, and doing Ethereum and Bitcoin, and primarily the Ether Bitcoin spread. And then one of my counterparties that I was trading with OTC was Blockfills, and Blockfills happens to be a particularly interesting company in the industry, and I'll tell you why. When I was trading with them, they came to me and said, "John, we're going to start pricing Ethereum options." And I said, "What are you going to do?" And they said, "We're going to price Ethereum options." I said, "There's no way." So they did. They created a whole options market for Ethereum. And at that moment, I decided to leave the spot trading side and go join Blockfills to build out the derivatives market for digital assets. And fast forward to today, we now have derivatives markets for Bitcoin, for Ether, for Cardano, for Solana, soon to be Avalanche, soon to be Polkadot, Tezos, all of these layer one blockchains. And the next catalyst for this market, which has been playing out for the past 12 months or so, is the introduction of Wall Street into these markets. The reason derivatives are extremely important for this transformation of Wall Street capital coming into crypto is that Wall Street needs to hedge. They are not going to just buy Bitcoin and hope it goes higher. They need to have a plan. They need to be structuring trades that have defined risk and reward. And these derivative markets are allowing Wall Street to come in and be the new bid in the market, and then they're using these derivatives to protect themselves and structure trades around it.
Wow, that's a lot to chew on. Sounds like Wall Street's ready to get rolling. Let me ask you a question. When you see these institutional players getting involved, what do you see for that ultimately for the price of Bitcoin? Like, does you see ultimately because they bet going up and down, so it just kind of balances itself out?
Yeah, so to date, I would say up until mid 2020, the crypto market was primarily driven by retail investors, and retail investors have come in through Coinbase, through Crypto.com, through Binance. You guys all know the exchanges, but that retail base can only take the price of these assets so high. There needs to be fresh capital. It needs to be deep pockets that come into this, and there also needs to be accredited investors who are justifying the risk return on investing in crypto. So to answer your question, Pedro, I think Wall Street is going to be critical in taking this market to all-time highs and really solidifying it as a diversified portfolio asset that will end up being in everybody's 401k or with their asset managers. It's going to start with Wall Street, trickle down. Next thing you know, it's going to be a no-brainer to have some exposure to crypto in every investment portfolio.
Beautiful. And you say you anticipate this happening, or at least Wall Street getting involved over the next 12 months or so?
Yeah, Wall Street's been coming in from what I can tell for, I'd say, the past year, but in particular the past six months, I would say. There's really been a shift, and we're starting to see that now with the launch of these ETFs that are happening, these exchange-traded products that are giving you exposure to Bitcoin. They're on an exchange that these hedge funds can already trade at. That's like the beginning of this institutional movement.
Excellent. So, in 2017 when the bull run was here, it was just that. It was primarily driven by retail investors. You'd get into like your Uber or your taxi driver, and they'd, to ask you about, random shit coins and tell you that this is going to be the next Lambo and so on and so forth, and they're driving a Toyota Corolla. But ultimately, this round you see something a lot different, right? You see a lot of smart capital getting involved, a lot of hedge funds, VCs, and of course governments as well. Yep. So with this, there's a lot of speculation in the industry that ultimately the bear market that we all anticipate will come at some point won't be as brutal as the bear market that started in 2018. What are your thoughts on that?
Well, in terms of brutality, and we're talking about price fluctuations, I think we are still susceptible to some very violent downward movements in the crypto market. What is different this time around is the ability to be defensive with your portfolio. So in 2018, if I had been holding Bitcoin for a couple years and had some nice capital gains, the only way I could really protect myself was by selling the Bitcoin for dollars or for stablecoin, taking a tax hit. Now we are having this explosion of a derivatives market, and I'll talk a little bit about some strategies that can be deployed to protect your crypto holdings long without necessarily having to sell your spot and take any capital gains hits. That's going to be the big difference between the next correction in the market, which is nearly an inevitability, relative to the prior corrections that we've experienced since inception.
Perfect. So let's talk a little bit about those strategies and exactly how is it, because the majority of us here today aren't affected by capital gains tax, as I'm sure you're aware. I know Alex is not the only one that's not affected by capital gains tax, but nonetheless, we'll act like some of the rest of you guys are in 22.
Not everybody's as fortunate as us here in Puerto Rico.
Yeah, so the people who are not Act 22 or Act 60, what is some of the things they could do to kind of like protect themselves from those hits?
Yeah, so let's talk a little bit about strategy. And before we really dive into, there's three strategies I'm going to talk about today. One of them is the basis trade. The other one is a covered call, and the third one is something called a zero-cost collar. And these are all strategies that have been deployed in traditional financial markets since derivatives were invented. So at Blockfills, what our business is we are institutional market makers. We serve the largest exchanges, we serve the largest OTC desks, hedge funds, high net worth individuals, family offices, with liquidity on spot, options, futures, lending and borrowing markets, structured notes, Bitcoin mining, finance, staking as a service, etc. So one of the best trades this year, aside from just being long spot crypto, but a trade that is attracting institutional capital that allows this market to go even further in terms of a market cap perspective, is something called the basis trade. The basis trade is arbitrage. It's a risk-free, directionalist trade, and the only risk is the counterparty. So In this case, Blockfills happens to be a counterparty on this trade. There are others in the industry. But the basis trade is when you buy spot Bitcoin and you sell a futures contract and you capture a spread between the price of Bitcoin today, which is the spot market, and the price of Bitcoin in the future. For example, there are futures markets for December 31st, January, February, March, the whole year. Every month, a futures contract expires. There is a spread between the spot price of Bitcoin and the futures price of Bitcoin. And at expiration, mathematical certainty, the futures contract and the spot market will equal each other. So a big hedge fund trade this year was buying spot Bitcoin, selling the futures, capturing that spread. It was annualizing about 15 to 25%, depending on what time of the year you were putting that in. And I know for crypto, 15 to 25% is not a very attractive yield. But let me tell you, you talk to asset managers in New York, and that's a hell of a yield. And you talk to asset managers in London or in Hong Kong, and now they're all taking a look at, well, what's going on here in crypto. So that is the basis trade. Now, I'd like to talk just real quick on what can be done to hedge downside exposure if you happen to be long spot crypto. Let's say you've been holding Bitcoin or Ether for a good amount of time. You have capital, you have some good gains on it. The options markets can be leveraged. And just real quick, how many people here are familiar at all with options? Could I see a handle? Just okay. This is a great crowd. So a call option is the right to buy an asset at a predetermined price at a predetermined expiration. Okay? A put option is the right to sell an asset at a predetermined strike price and a predetermined expiration. The strategy that I have coined, the optimized HODL, utilizes call options and put options. So if you are long spot Bitcoin, you can sell an out-of-the-money call option, let's say 50% to 75% out of the money from where spot is trading today. So you have 50 to 75% upside every month. You take the proceeds from selling that call option and you immediately buy a put. And a put option increases in value as the market moves lower. So this strategy, and by the way, it's zero cost. We are paying for the protection. We're paying for that put option with the proceeds we receive from the call. So now as Bitcoin gyrates and fluctuates every month, when Bitcoin moves lower, guys and girls who have this zero cost collar on have profit on their put options. And what they have been doing all year, this is some of the most aggressive funds in the market, they've been taking those profits from the put option when the market moves lower and just buying spot at a lower price and then restriking the collar for the next month. I know that's a lot there. I'm happy to break it into it.
Sounds like they bet on it going both up and down.
Up and down.
And when it goes down, they buy it at a cheaper price and they get paid on the way up.
That's right. So in the beauty of this structure, and you're doing this structure every month, because just like the futures markets where there's an expiration every month, the options markets have an expiration every month. So for example, right now, December 31st is the next options expiration for Bitcoin and Ethereum. And what many funds have been doing, and this was extremely helpful in the current scenario we're in now, is, and this has been happening all quarter, they're selling calls 50% to 75% above the spot market, which means you have upside on your Bitcoin 50% to 75% per month. And then they're taking those proceeds and buying a put. And so you have upside exposure for your portfolio, but now you also have free protection. If the market moves lower, you take that protection off. You either put the cash in your pocket or you just buy more spot Bitcoin on a dip. So, so this is a fascinating part. Thank you for the question. The question was, how much lower are they buying the puts relative to the calls? So, fascinatingly about the crypto markets, in particular Bitcoin and Ether options, is something called a put-call skew. And in simple English, the question is, how much more expensive are the call options relative to the put options? In traditional markets, put options, protection for a portfolio, are more expensive than call options. But in crypto, the call options are more expensive than the protection because the entire market is bullish and thinks this thing's going to 100,000 this year. So what in plain English, what that means is you can take advantage as a long-term holder of crypto of the market sentiment by selling calls, let's say 50 to 75% out of the money, and buying puts 20 to 25% out of the money. So that skew really plays into your favor by being a crypto investor.
So,
Great question.
so where do you see your most action at? Where do you do your most trading? Binance?
So Blockfills, we are a market maker. We are a liquidity provider. We are the guys you are probably trading with through the exchanges that you're accessing, but we are direct liquidity. So instead of using a public exchange that retail investors are accessing, institutional capital or high net worth individuals and family offices can come directly to the market makers that are serving the retail community.
So in other words, really rich people and family offices and such. So let's talk a little bit about how you view the market now. Everybody seems to be rather bullish in it. What do you see? How long you think we got left to this bull market?
Yeah, so in terms of direction, it's a coin flip. And honestly, that's just statistical probabilities. The market either move higher or lower, and it's literally 50-50 chance. And there is no way to really have a better insight than a coin flip. That is the beauty of this zero-cost collar strategy I'm talking about. We all want to be long crypto, but we have no clue where it's going. So we might as well give ourselves upside every month and have free protection around our portfolio in case we end up in a scenario like we are now where we came off the highs at 68K and now we're trading around 45K, right? So if we are, and I'm still very bullish, by the way. I'm extremely bullish, never been more bullish, really. But since we don't know where this thing is going, having that rolling monthly protection allows you to optimize your portfolio and end up buying spot on these dips that everyone talks about buying the dip. Well, I don't know. I have most of my stuff in crypto, so I can't really buy the dip. But if I have a put option that I can cash out on as the market moves lower, I can take the proceeds from that put and buy the dip.
That makes sense. Anybody got any questions for Mr. Devine up here?
Can you say that one more time? Yeah, so in crypto, okay, so the question is, what is the lot size on options? In traditional markets, if you buy a call option on stocks, it's 100 shares per option. That's a standardized format. So in OTC execution, you can be specific on exactly the quantity. The industry standard is 1 Bitcoin per options contract. And then for Ether, it's 1 Ether. And for Solana, it's 1 Solana. And for Cardano, it's 1 Cardano. Yeah, so there are public exchanges. The largest exchange with open interest is an exchange called Deribit out of Panama. You will find that U.S. investors really don't have access to those markets for reasons that are way beyond my pay grade. But as an institution in the U.S., your route is to find a direct liquidity provider that can deal with eligible contract participants.
Such as he's sitting right there.
Yeah, so an eligible contract participant, there's some thresholds in terms of how much capital you have on your balance sheet or in your portfolio, and I'm happy to talk about what those thresholds are with you.
Next question. You got to come up here, brother, so we can hear you. You got a microphone for him?
As far as the Greeks, I mean, there's two that don't really matter that much, but delta matters a bunch, gamma matters, and theta matters a whole lot. Yeah. So when you're talking about theta, like what kind of theta decay do you see in these Bitcoin or Ethereum options as opposed to like in the S&P 500 or in the NASDAQ? I'll just say as opposed to the NASDAQ. And then does it have that typical kind of trail off where it trails off into you know, like the most of the Theta Decay is in the last week or in the last month of the option, or like what's your strategy with as far as dealing with the Greek symbols?
Yeah, okay, that's a great question. So he's asking about Greeks, and this is really going into the mechanics of how an options contract is priced. And there's something called the Black-Scholes model, which you know, some light reading, emphasis the light reading part. But you know, at your question on theta and time decay, yes, it's a very similar slope to traditional finance and how options are priced, because we're using the same models that are being used in traditional finance, right? And then from my perspective, really as a market maker, it's about managing deltas. So my whole focus, I am not speculating on theta or time decay. I'm more focused on how do I manage a book that is delta neutral and allow two-way flow to come through my markets and keep that profile in a delta neutral state.
If we're buying these puts, then how many months out would you recommend that we buy them out, and how many months out would you recommend that we sell those puts and then flip into a longer dated put to avoid that last little bit of theta decay where the thing crashes to zero, basically?
Yes. Yeah. Okay. So the question is, you know, when should you? How far out down the curve should you put these trades on? When should you take them off? Right. That's basically the question. Okay. So just to reiterate, options markets. I mean, technically you have overnight options, but for simplicity's sake, options work on a monthly calendar structure. Every month there's an options expiration. And by the way, caveat aside, if you're really paying attention to Bitcoin prices, the options expirations are having a tremendous impact on where spot price is going, okay? But to answer your question, I think zero-cost collars, which is what I'm talking about, selling calls and buying free protection with the proceeds from the call, are best utilized on a rolling monthly basis, because Bitcoin can go up 50% in a month. I don't really want to have a zero-cost collar on a quarterly or a half-a-year schedule, because now I'm putting myself in a position where I might get called away from some stuff. So the goal of this strategy is to give myself monthly upside on Bitcoin. If it goes up 50%, I want to capture that gain, but I also want to have the protection. So I sell 50% out of the money, I buy whatever put I can for free, and with that skew, you're going to get a really good put. But to finalize it, every month, this trade needs to be put on and rolled. And when you roll it ahead of the expiration. Typically, I mean, you can really narrow down the data science on it, but probably between 3 and 5 days prior to expiration.
Next question. Come on up here, brother.
Oh, sorry, I didn't mean to hijack him. But I don't know if you talked about it earlier or mentioned anything about it, but how does something like this platform, or like what this trading does, do for a community like Puerto Rico? You know, people, for someone who doesn't know anything about trading, investing, or who doesn't have the means to put away, set aside money that they can afford to not use. So since we're here, you know, how would something like this, what would be the offer to them? You know, what would be the plug for the community? Like, how do they get involved?
Yeah.
Or what does it do to benefit them in a sense, besides just, you know, could make them money?
Oh yeah, no, I totally get it. And now let's start this answer by saying, you know, with Dodd-Frank legislation in 2007, they made it a lot more difficult for, let me just say, you know, nicely, average people to be involved in derivatives markets and defensive strategies around their portfolio. So, as I mentioned earlier, you need to be an eligible contract participant to even participate in this stuff at the moment. Hopefully, I mean, at some point, hopefully that changes. So right now, most people really cannot participate in these strategies. I would think in Puerto Rico, especially with our community here, there's a lot more people who can participate. Obviously, the hedge fund space from Wall Street, which is what I'm talking about, this is the real catalyst to bring Wall Street capital in. But to answer your question, how we can help the community here in Puerto Rico, which, by the way, should be all of our #1 goals. If we're going to move to Puerto Rico and enjoy this beautiful island and enjoy their beautiful culture and enjoy all the tax benefits, our primary goal should be focused on how can we help the community. So for me, it's going to be education, doing stuff like this. So I've written a book on, it's titled Introduction to Futures Markets, and I met a very lovely Puerto Rican, I believe she may even be here, hopefully she is, who translated that book for me into Spanish. And now we are giving that book away in Spanish to help people on this island start to learn about what are commodity markets, number one. What is the oil market? We got to start there before we get to Bitcoin. You got to figure out, why does your price at the gas tank keep going up and down? Well, it's the price of oil, okay? They need to start off there. Then we start to move into Bitcoin and digital assets, and how can the community here start to invest, even at a simple level, opening a Coinbase Pro account or Binance, crypto, whatever. So it starts with education on my perspective and translating material into Spanish. That's really the caveat here. We want to speak in their language so they can feel comfortable as they're learning these complex topics.
And I will tell you guys that anybody that I've ever reached out to John for and say, hey, these guys are, trading, or they're learning how to trade, whatever, what have you. Can you help them out? Can you teach them? John has been more than willing to help anybody, even when there was serious language barriers. So I can imagine some of the conversations, some of the guys that you've helped. Any more questions? Over here. Jorge.
Thanks. Given that the basis trade has, seemingly more or less collapsed, where do you see the institutional capital that was looking for, relatively safer trades looking to rotate into now?
Yeah, so when we talk about the basis trading collapsing, what he's referring to is the yield that can be generated through arbitrage or a risk-free trade by buying spot Bitcoin and selling a futures contract. That basis trade moves all over the place. It typically follows the trend of Bitcoin. So when Bitcoin is bid, the basis trade can annualize between 15 and 25%, which is a fantastic yield, by the way, on a risk-free basis. But when Bitcoin prices compress, we see the basis compress as well. Like right now, I believe the basis is trading somewhere but like 6% annualized, maybe even less. I think it did go flat at some point, which is expected. These are financial markets that move up and down, and the risk-free return is not always going to be staring you in the face. You have to be strategic about when you put these risk-free trades on. But to answer your question, where is institutional capital going to find more arbitrage? I'm starting to see traditional hedge funds becoming comfortable lending U.S. dollars in the crypto community for over-collateralized Bitcoin. So like predominantly, that's been a huge thing with DeFi. One of the leading things in DeFi is over-collateralized lending. You have a protocol that you put in some Ether or some Bitcoin, it spits out USDC or USDT at a predetermined loan-to-value ratio, right? But now we're starting to see institutional capital on Wall Street getting comfortable with lending dollars to crypto market participants in exchange for over-collateralized crypto. And now we can take our dollars and buy houses and buy cars and still have our core spot holdings, right? And the net benefit of that for the entire crypto community is the cost to borrow goes lower. Because as we have more dollars willing to lend into the ecosystem, that cost of capital is going to depreciate.
One more question.
When you were mentioning the futures market just now, it reminded me of another question I have. So those ETFs have come out, BitO, and then there's 4 of them that have come out so far.
Yeah.
These are all futures-based ETFs,
Right.
so not spot, which means that it's nothing better than a bucket shop from the old 1920s or whatever, right, before the protections. But so in other words, the trade with that is that they constantly have to buy Bitcoin on the futures market, and then so people can sell to them on the futures market, like the hedge. So in other words, you have this constant arbitrage that's going on there, where they're gonna dump the price, and then they're gonna sell the futures to people who are buying the futures, and then they're gonna dump the underlying right near expiration, or right near the time that it has to be offloaded, and then it'll pop back up afterwards. How does that factor at all into the options? Like when you're trading the options, are you trading the options on the futures price, or on the on like the price of a basket of exchanges, or or like that Deribit, or just the price on that exchange, or and then also like how does the arrival of these new Bitcoin futures ETFs that are in general bearish because they create that downward pressure from that movement there, how does that affect this strategy that you're employing here? Is it good or is it bad? Does it not change it at all? How does it work?
I'm going to start with your second question. If you can refresh me on the first one while I get through this answer, as I'm already thinking about it. So this is what I used to do in my prior life. When you have ETFs that are based on futures contracts and not based on the underlying physical asset, you have a lot of market manipulation that comes into play, and this is something we call the roll. So like as I was saying before, futures markets have a monthly expiration schedule, right? So if you have an ETF, a Bitcoin ETF, or an Ethereum ETF that is only holding futures contracts, every single month that fund manager has to sell the futures contracts they hold at expiration and buy the preceding month, the next month future. Okay, and market makers, like, in my former life, I'm not terribly proud to admit it, but what we would do is we will back up the price of the next futures contract as we get closer to expiration, so that fund managers that are running ETFs have to pay a spread to sell their front month futures and then buy the second month futures to keep that ETF float going, right? And that's what's happening today. My humble opinion is that Bitcoin ETFs that are based on futures contracts are going to go to freaking zero. I don't see how they can survive based on that contango every single month. And as we have futures or ETFs that come into play that are based on spot Bitcoin instead of a futures contract, all the volume from Wall Street's going to go into that ETF. So to answer your question, how does it help the strategies I'm talking about? Well, theoretically, and it has played out this way thus far, it's pretty limited data, but the basis, although we're compressed at the moment because Bitcoin's selling off, but the basis is finding legs. Okay, so the basis in Bitcoin-denominated futures, which is what is dealt OTC, or at some of these offshore exchanges, the basis, the spread between the front month and the back month is staying elevated longer due to the arbitrage you can do against Bitcoin-denominated futures and cash-settled futures. Yeah, so it keeps the yield going for the basis.
Because in those foreign ETFs are spot ETFs, so that's why that works there, like the Canadian ones and things.
Yeah.
Why don't you guys go on a date?
I mean, so to your point, I'll nail this down here though. But like when I talk about the basis trade, a risk-free trade, okay, is when you're buying spot Bitcoin and selling a futures. You can't do that with a futures contract that is based on futures. You can only do that with a futures contract that has spot Bitcoin supporting it. Okay, so that's the real trade. That's where this market's going. These first ETFs are really just to get the SEC to say okay, prove a model, and move forward.
You keep them wondering, I might even get them to pay for it. Maybe we'll figure it out. Anybody else got any questions? All right, you guys, let me get a round of applause for my guest, Mr. John Devine, please.